Welcome back to another episode of the Cash Compound Podcast. In today's episode, we're going to talk about the guy that's on the radio so much, always telling people to buy term and invest the difference. Let's go to his website.
All right.
Let's look at what he's got on there, and let's see if he's telling the truth, if we should be paying attention or not.
Does this man's name rhyme with Brave Ramsey?
And with me today, we've got Ryan.
Hello.
Ryan, do you tell people your last name?
Hendrick.
On these podcasts? Okay.
Yeah, Ryan Hendrick. Yes.
Cool.
Not Hendricks.
Not
no
with an
S
S.
at the end. Yeah.
No S, just the K.
Yeah,
anyway, in this episode, man, we're going to have some fun in this episode today. See, here's what happens. Very often, we get people who are influenced by an influencer named Mr. Dave Ramsey. And while we do respect a lot of the things that he does and tells folks as far as paying off debt and trying to live within your means, there are a few things that he tells folks that are incorrect.
Indeed.
And we're going to dive into them today. We're not going to have you take our word for it. We are going directly to the source.
Yep. So there's this article on his site called Term versus Whole Life Insurance. What's the difference? So we're going to have pictures of this as we go over all of these fun things and go over some of the quotes that they have in here and everything. But feel free to Google search this, read it for yourself. It takes about 10 minutes to read. Not a big deal.
There you go. You can type that into Google, or you can go to his website. I think his website officially is RamseySolutions.com.
Correct.
And term versus whole life insurance, what's the difference is where we're headed. We're going to see what he's saying, and we're going to dissect that. So if you're watching us on YouTube, you'll have the visuals up in front of you. If you're listening to us via podcast in your car or on the road, we will make sure that we walk you through exactly what's happening before we jump in and start chatting. You want to start with the first one?
Yeah. So we're just going to hit some of these singular quotes. So this part right at the beginning, what is the difference between term versus whole life insurance? We'll give it to you straight. Term life insurance works while whole life fails.
Ooh.
Made his
let's stop there.
made his opinion.
Let's stop there.
Abundantly clear.
That's his first. That's like the first line of the first paragraph of his first point. Is that right?
No, there's a little
more.
There's
Okay.
a little flavor text at the beginning.
All right, no problem.
But this is the first
Meat.
full-blown section.
Yeah, this is the first meet. Okay, so let's talk about it. He literally says, "We'll give it to you straight. Term life insurance works while whole life fails." I hate to break it to everyone who's listening. That is incorrect. That is wrong on so many levels. So here's my question for you, Ryan. Let's see if you know the answer. Term life insurance only pays out the death benefit if the person passes in the term.
Mm-hmm.
Okay, we're on the same page about that?
Yes, we are.
Okay, do you happen to know by any chance, what percentage of term life insurance actually pays out?
Last time we Googled it, 2%.
That's correct. 2% of term life insurance actually pays out. Here's why. Let me dive into it. The insurance company is not stupid. The reason they're offering term life insurance, 10 years, 20 years, 30-year terms on these life insurance is because they know that you will not pass in that term unless it is an accident. That's the only reason. The insurance companies have an entire team of people called actuaries who are very, very, very good at their job. How good are they? Well, there's never been a mutual insurance company that's ever gone out of business in the history of the United States. And when they offer things like term insurance, they do that knowing that they won't, more than likely, will not have to pay. Now, the alternative here, which he says does not work, or as he says, fails, is whole life insurance. So let me ask you this one, Ryan. Let's say someone has whole life insurance and they have it for their whole life, and then they pass away.
Yeah.
How often does that pay out?
100% of the time.
Oh, man, that seems like the exact opposite of what he said on his site. That's interesting.
The interesting thing here, let's go ahead and go to the second line because he starts with the opening salvo of that line, but we have to get into the framework of where's he coming from? How does he think about insurance as a whole? The reason is simple. The true purpose of life insurance is to replace your income if you die and to do it as cheaply as possible. Do you agree with that? What are your thoughts on that?
I do not agree with that at all. Again, he's saying the purpose of life insurance is to replace your income if you die. I don't agree with that. So insurance in itself is to protect against loss, right? There is a thing. Well, I'd say it more like this. He's not 100% wrong like he was with his first sentence in this second one. Okay. Here's what I mean. When you get car insurance or something, let's say you drive a $25,000 car, you cannot insure that car for $50,000. The point of the insurance is to protect against loss. If your car's worth 25, then you'll get a check for 25. Does that make sense? You can't do more. So yes, I'm with you that there's income to be replaced if you were to pass away, but there's much, much, much more than income as well that needs to be replaced if you pass away. That's one. And then second, and to do it as cheaply as possible. That's your perspective on it, but I don't really agree with that either, right? That type of reasoning does not work with any other category in your life.
Yeah. If I have to choose between an NBA game or a high school game, the high school game's cheaper.
The point is to go to the basketball game as cheaply as possible.
To watch basketball, I'm going to go to the high school game because it's the cheapest. Now, not throwing shade on high school basketball, but they're two very different experiences, right, and you get what you pay for.
Right. Again, I don't agree because I think that type of reasoning doesn't work with anything else. It surely doesn't work here, right? It's not everything is an orange, but this is an apple. And it just doesn't work. Again, not 100% wrong on that particular sentence. Like his first sentence was completely wrong, literally backward.
But an oversimplification.
But a big oversimplification. What else we got?
All right, end of this paragraph, and that's exactly what term life does. But whole life, it's costly, confusing because it puts investing into the mix with insurance. It adds up to an expensive mess, which we'll discuss in detail below.
Interesting.
Yeah, it's costly. Sure, it's more, but you're insured for your whole life. The confusing because it puts investing into the mix with certain products. I think we need to remember insurance companies have lots of different products. Term insurance is a product. Universal life insurance is a product. Whole life insurance is a product.
That's right.
So they're different ones. So to lump all whole life insurance into one basket and say it's all bad because of this, the policies that we create,
that's what I call it. It's just wrong.
Yeah, because the policies we create, that we aren't interested in investing.
There's no investment avenue in the policies that we generate. So actually, you might not know this. I know you're kind of new to learning all the nuances of insurance, right? It's one thing to understand how to be a good banker, teach someone else how to be a good banker, but that doesn't mean you came from an insurance background and you know a bunch of insurance stuff all of a sudden, right? So actually, he's using the wrong term on that particular sentence. In that particular sentence, he says, but whole life, it's costly, confusing because it puts investing into the mix with insurance. And in this particular sentence, he should not be saying whole life. He should be saying permanent life. Permanent life is actually the adverse of term. That's the technical term. Term, permanent. Inside of permanent, you have those options that you just mentioned: universal, whole, variable. You got all sorts of stuff going on in there, right? And so he's singling out whole when he really should be saying permanent. If he said permanent, I'd give him a little bit more slack. But because he's saying whole, I've got to stop him and go, that is absolutely incorrect, Mr. Dave. Whole life does not put investing into the mix at all with insurance. Universal does, variable does, but not whole.
Yep. So we're going to skip around a little bit here and just go over particular quotes. So here's the next section. Term life has a set premium that remains the same throughout the life of the policy, and it only lasts for a defined number of years. Whole life premiums can vary a lot, last your whole life even after you're past the age when you'd need a death benefit for dependents, and are overcomplicated by bad investment options.
Again, he's just incorrect. It's not true. So reminder of what I just said. If he says permanent life premiums can vary a lot, I'd give him a little bit more slack.
Yeah.
Because he's now using the term that encompasses whole and variable and universal and stuff like that. But he doesn't. He says whole life. And because he says whole life, it's wrong. Whole life insurance premiums do not vary at all. They are the same. What actually can change is term life, which he says it remains the same throughout the life of the policy. That's true. But the second you try to get a new term policy because you did not pass away, the insurance premiums are astronomical. This actually is a real life story. You ready for this?
Yep.
So a young couple called me. They were experiencing the end of their 30-year term insurance. So they're in their mid 60s. They were paying about, I think they told me it was about $500 all year for their term insurance. So that's about $50 a month, or maybe I'm a little off, but I think it's like somewhere around there. And their death benefit was pretty substantial. Now their 30-year term was running up. They did not pass away. So that's a 0% payout, right, on that term policy. A lot of money they put in, but no money coming out. And they wanted to renew. And guess what the premiums were if they were to renew the same policy with their same company now that they're in their 60s on a 30-year spread? Guess what they were? They went from $50 a month to?
I'm going to guess 500.
$15,000 a year. $15,000 a year. Now, granted, their death benefit was high, $500,000, $1 million. I don't really remember what it was, but think about it. The insurance company knows you're going this time. If they give a 60-year-old a 30-year term, chances are probably pretty high that they're not going to make it all 30 years. So what does the insurance company do? Jack those premiums up. So while he is correct in saying term life has a set premium that remains the same throughout the life of the policy, that's true, but they can jack those premiums up off you once you don't pass during your term. Whole life also has a set premium that remains the same throughout the life of the policy, and it just so happens that the life of a whole life policy is
your whole life.
I should.
There we go.
There it is.
Unless you plan on living past 121, that'd be really impressive, though. So, yeah.
Yeah, I don't know anybody getting up that high.
I think the thing to remember is with a term life insurance policy, most people get that during the prime years of their lives.
That's right.
And so the twilight years of a person's life, when, there's a significantly higher threat of, expiring, then it's beneficial to have whole life because you're still paying the same thing that you've been paying for the last 30 years. And the numbers have only been increasing, especially with the policies that we create.
That's right. That's exactly it. What else he's got?
He says, don't mix insurance with investing.
I agree.
Yeah.
Those are universal policies. Those are variable policies. We agree wholeheartedly. Do not mix insurance with investing. Do not mix cash value with investing. When we teach people about becoming a bank, here's my question for you. Think about your normal bank account.
Got it.
Normal bank account, your checking account at whatever bank you use. What bank you use?
Southern First.
Southern First Bank. Okay. For all of those who don't live in South Carolina, you might not know about that one. It's a credit union. No, it's a bank.
Bank?
I don't know what it is. I don't use it. Okay, you use Southern First. Here's my question for you, Ryan. Would you tie your checking account to market trends?
To market trends? Absolutely not.
Absolutely not. So if we talk about becoming your own banker, why in the world would you tie that to market trends?
It would be an incredibly unwise move.
So goofy. Now, you've probably heard many of folk on the internet, socials, whatever, talking about IUL. Talking about these variable or universal products that are tied to market trends. We think that's incredibly foolish.
Yeah.
If you're going to be using your policy for banking. Again, my question's simple. Would you tie your checking account to market trends? I bet you'd tell me no. Anyway, what else do you say?
Yeah, so we're actually in agreement with Ramsey on that one. It just doesn't make sense in that regard. All right, so what is term insurance? Term life plans are much more affordable than whole life insurance. This is because the term life policy has no cash value unless you die during the course of the term. So, giving some information, it's correct.
This is very interesting. So based on what he's saying on his website, he's calling the death benefit the cash value. Right? This is because the term life policy has no cash value unless you die during the course of the term.
Yeah.
If you die, the only thing that comes is a death benefit, and it doesn't go to you. It goes to other people. But he's considering that to be cash value. That's just interesting to me.
Yeah. Two different things.
I think so.
And then skip a paragraph. Despite what you'll hear from whole life salesmen, life insurance has just one job: to replace an income. We disagree with that.
I disagree with that wholeheartedly.
Yeah. And the entire business is built on a completely different way of utilizing life insurance.
Yep.
So saying it can only do one thing that's like saying Steph can only shoot threes.
Yeah. I think he can dribble. I think he can pass. I think he can make layups.
Defend.
Right.
All right. So he has a section here, term life pros and cons.
This is interesting. So this is the second time he's brought up this first pro.
Yeah.
Right.
So pro, number one, term is way more affordable than whole life. And we already went over different products, different price. It is what it is.
This is very interesting to me that he keeps harping on this, because you're getting two different things. Like we said it earlier with the little basketball example, right? High school basketball games are much more affordable than NBA basketball games. No, who's arguing with you?
No one.
You keep saying it, but who's arguing with you?
Yeah.
We agree they're different, though.
Yep.
Right? In that,
Bikes are cheaper than cars.
Yeah.
So if the main purpose is for me to get from point A to point B, then why wouldn't I just invest in a bike?
Then you just use a bike, I guess. I mean, it's cheaper.
It's actually, some people do that, but
Yeah,
it does not work.
But what I'm saying is that can't be your entire argument, right? I agree with you that it's cheaper, but I also agree that cars have air conditioning.
Yep.
And maybe and they have a roof, and some days it might be raining, right?
Like today.
I mean, it is raining today where we are. But I just, man, that's crazy that he keeps harping on that without talking about anything else.
Yeah. I think he's just looking at cost and then calling it there, So
let's see what else he's got.
Next section.
These are his pros
Yeah.
for term insurance. What's he got?
Pro number 2 gives you the option to invest however you prefer instead of locking your cash into a very low return investment.
Oh, I'm sorry. This is a pro for term. I was like, what is he talking about? Okay, so he's saying if you get term
his big
insurance-
thing is, you get term insurance and invest the difference. That's his big catchphrase with that.
So he's saying if you get term, it gives you the option to invest however you want. Well, of course, because you can do anything you want. That's very goofy to me too, man. If you buy term, you can go to any basketball game you want. I mean, sure, but you still have to spend your money to do it.
Yeah.
Right? This is weird. Okay.
It's still money out of your wallet in a different way.
Instead of locking your cash into a very low return investment, is he talking about the whole life policies when he says that? Because there's no cons in the section on his site.
I mean, I think that is what he's doing.
Okay.
And we'll get to the pros and cons of the whole life as well, so he'll probably hit on that there.
Okay.
Number 3, term allows you to move toward becoming self-insured.
Oh my goodness. This is one of my biggest pet peeves. I don't talk about it very often because thankfully, most people realize that this is very stupid. Do you know what being self-insured means?
It means that you have enough money to pay for whatever might happen.
Why would anyone in their right mind do that? No, I'm being serious. Self-insure yourself on your car insurance.
Yeah, that's going to be a bad day if I get into an accident. Yeah.
So you're cool replacing your car at cost. You're cool replacing their car at cost. What about a hospital bill? What if they have to go to the hospital? What if you have to go to the hospital? Why would you willingly give up all that money when you could have paid $50 a month to State Farm?
And he's huge on homeowners insurance, car insurance. He's a huge proponent of those things.
But he says you should be self-insured on life insurance. But he just told me it was to replace an income. Man, it's just not adding up to me. So anyway, that's a podcast topic for a different episode, being self-insured. How goofy can you be?
Yeah.
Why in the world would you do that?
And then the cons of term insurance, you will hear some smack about a lack of investment options, but this isn't so much as a con as it is a way to muddy the waters and sell you whole life. So yeah, the only con is that you might buy whole life instead of it.
The only con to term life is that you might hear some smack about lack of investment options. I disagree.
Yeah.
I disagree.
Where's the little section of, you're one of those 98% who doesn't die. Then you just threw all that money away your entire life.
That's very.
You could have invested that money.
Very interesting.
If we're going to use the same language.
Very, very interesting.
All right. So now we're going to go to the whole life. So what is whole life? And again, I'm skipping some stuff here, but whole life insurance costs more because it's designed to build cash value, which means it tries to double up as an investment account and life insurance.
False. That's not true at all.
Mm-hmm.
Cash value is just the equity of the death benefit that you have already paid for. It's not designed to build cash value. No.
Yeah. And the thing is, sure, this death benefit isn't going to be as much as term insurance. With term insurance, they rarely have to pay that out. So they can put a high number in there.
Yeah.
Whole life, they know you're going to die. So
at some point,
they have to calculate that. Yeah, they have to calculate that and pick the numbers accordingly. So
isn't that funny if you really think about it? Term has such a higher death benefit and a 2% rate of actually working. Whole life, as long as you have it, has a 100% rate of actually working, and they give you a little lower of a number. I wonder why.
Me too.
Yeah.
What could that possibly be?
Come on, people.
If only
anyway, his sentence is very wrong. Not designed to build cash value. Whole life insurance is not designed to build cash value, folks. Whole life insurance protects against loss of your life, just like any other insurance does, for your whole life. And since you have insurance for your whole life, every time you make a premium payment, the insurance company is saying, here's how much of that benefit that you will get. It's whole life. We know it's going to happen. You will get a benefit at some point. Here's how much of that benefit you could have now if you want to. And they call that cash value. It's not designed for cash value. It's designed just like any other insurance. It just has cash value in it because you own the thing. It's around for your whole life.
Yep.
Man.
Yeah.
So then he says it tries to double up as an investment account and life insurance.
Again, and we already discussed this. That isn't all. Sure, some whole life policies might do that. I'm sorry, not whole life, permanent life. Some of those might do that, but not all of them. You can't lump them all in the same boat because.
He's very lumping them all in the same boat.
Yeah. So, all right.
All right, we got pros and cons of whole life. A lot of things in this section.
Yeah, a lot of cons. Interesting.
All right, interesting.
So, whole life, cons. 1, far more expensive than term life.
And he's harping on that thing, ain't he?
Yeah, that seems to be the main focus.
All right, and off-brand Rice Krispies are a lot less expensive than on-brand Rice Krispies.
Mm-hmm.
So.
Yep. 2, tries to do 2 financial jobs, insurance and investing at once, but ends up doing neither well.
I had to laugh at this one. 1, no, it's not trying to do 2 financial jobs. Again, assuming that you're not doing variable or universal, because those are investment vehicles. So yeah,
we agree on that front.
If you're in that field, that's tough. But this is whole life pros and cons, and whole life is whole life. That's a product name. So again, if he put permanent life, then maybe I'd give it to him, but he didn't. He put whole. That's a product, right? He didn't say Toyota. He said Camry. The Camry does this. That's not true. The Camry does not. Right? Does that make sense? And then second, it ends up doing neither well. It has a 100% payout rate. I don't understand how he can say it doesn't do it well.
Yeah.
Does it better than the product that he pushes?
Yeah.
By 98%.
Indeed. All right. So, number 3, delays or stops you from ever becoming self-insured.
It should. Being self-insured is very foolish. Very, 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 very goofy.
That's a different podcast for
I
a
don't
different
know
time.
anyone. Think about it. Tell me. I would love, if you're watching, if you're listening, put this in the comments. Send us an email. Okay. I don't care if you're on Spotify, Apple Music, Google Play, whatever you're listening to this podcast. Send me something. Do you know anyone in their old age that does not want to give any money to the next generation, to their kids? I did it. I'm old. I'm self-insured. Or as Dave is saying, it replaces income. So if there's no income to replace because they stopped working, right? And then they just pass away, they give you nothing. Mm-hmm. I don't know people who aspire to do that. I don't know family or children of those people who aspire to have that happen to them. Do you? That's my question.
I don't. All right. Number 4, you and your family can lose a ton of your cash value if you die without cashing it out.
Hold on a second.
Terminology is all wonky here.
Terminology is super wonky here. Didn't he tell us on the last page that cash value was the death benefit? He equated them to the exact same thing. He said, unless you go back a page.
We're going to go back.
Go back a page. What did he say about that cash value? Right. Oh, there it is.
Yeah. This is because the term life policy has no cash value unless you die during the course of the term.
Term policies have no cash value unless you die during the course of the term. That is not cash value. That is a death benefit. But he's equating them to be the same in that sentence, is he not?
Yes.
Okay. Then on the whole life con, he says you and your family lose a bunch of cash if you die. Excuse me? No, you do not.
Yeah, you get a death benefit.
You get the death benefit. Are you joking? You and your family, in parentheses, lose money if you die. That is false. That is super false. What type of insurance works like that? Don't buy car insurance. If you crash, you're going to lose a bunch of money.
Yeah.
How? That's the point of the insurance.
Yeah.
To not let that
to cover
happen.
that risk. Yeah.
Don't buy phone insurance. Drop your phone in the sink. You're going to lose a bunch of money. No, I'm going to I'm going to get a check to get a new phone. That's how insurance works. What is he? That's the most wrong thing. No, it's not. Cause the first sentence was 100% wrong.
Yeah.
This is just like 150% wrong though.
Oh.
That's super. And he put in parentheses and your family. I'm embarrassed for him.
Cause last time I checked, you said a beneficiary. So anyway, goes to the pros of whole life. The only one we've discovered, whole life is better than no life insurance at all.
Oh, come on.
2, hunting for good things about whole life could become a new hobby.
Oh, he's trolling us with the pros.
3, trying to think of whole life benefits could help you build patience.
Wow, he's trolling us. And 4, still waiting.
Still waiting. ...
I got some benefits for you. I got some pros. Ryan, you got a pro? Give us one pro.
Of a whole life insurance?
Yeah, whole life policy.
It's guaranteed to pay out, since we've already, brought that up multiple times. And term policies, only 2% of them pay out.
I love it.
With a whole life, it's going to pay out. You will get the death benefit, not the cash value. Cash value is the equity of the death benefit. You get the death benefit. Or rather, not you, but your beneficiary gets it.
There you go. I've got one. There is cash value. Right? How fun is it to pay $50 a month for 30 years like the couple I was just chatting about? And at the end of that term, nothing. You get nothing. You have nothing. And you can't afford the new premiums either. Well, in whole life, you get cash value and you can spend that cash value. And if you've got a policy designed for banking, which is what we do, you have a significant amount of cash value that you can start using right away. What else we got?
Still waiting.
I can't believe he just trolled us with the pro section.
Moral of the story is this: keep your insurance and your investments separate.
Wild. I do agree. Again, if you're investing with your insurance, variable or universal, we do not recommend that. You can get into so much trouble because there's a bunch of options on these policies. And if you don't know what you're doing or you're not doing it well, you will eat through that cash value that's supposed to be there and your policy will lapse on itself. We do not recommend here at the Cash Compound variable or universal policies or any of the sort. We recommend one policy only, and that is whole life. And that is a whole life policy designed for banking. That way you can take that cash value out and you can go buy stuff or pay stuff off or
and the money is guaranteed to go up. It's a guaranteed contract that the money will compound and go up over time.
There it is.
So
what else you got? You got more stuff.
Yeah.
I was hoping he'd be done.
I mean, we're almost done. I mean,
all them falsities.
We've already hit a lot of these things, but there is one thing I want to hit here. So there's a cost comparison, term versus whole life. He brings up this mythical guy named Greg and goes over, the things he could have done, blah, blah, blah. So we're going to skip ahead after the whole scenario that he gives and everything, and it tells you why whole life is bad, why 20-year term is good, and but this sentence right here, I didn't highlight it, but what if Greg instead, remember he says buy term, invest the difference. What if Greg instead chose the $13 20-year term life policy and decided to invest the $247 per month he'll save by not choosing the whole life plan? If he invests in good growth stock mutual funds with an 11% average annual rate of return, he would have, and then throws out big numbers. How do we feel about rate of return, John?
Okay.
Average rate of return.
I want to, before I get to that problem, I want to go to the next problem. He would have. Lie. How can you tell someone that in an investment? How can you get away with it? As big as he is, as famous as he is, how can you get away with a sentence like that on his site? That frustrates me a little bit because people read that and they believe it. Let me tell you that, again, folks at home.
Even the insurance policies will say this is not guaranteed. These are spitball numbers. Yeah, they're highly educated, but they're not guaranteed. So to say he would have totally gotten this amount. It frustrates
me so much about wording and phrasing. And I'm not an English major or anything like that, but I think I know one or two things about investments, and that's the fact that it can go up and it can go down. And when I'm 50 or 60 or 70 years old, if someone says, if you invest here, you will have, I know that they lied to me. Period. You're lying. You do not know that I will have anything, right?
Yeah.
I mean, and again, I'm not trying to beat around the bush. I'm trying to say you guys at home know that to be true about investments, right? So watch this. If you invest in Dogecoin, you will have $1 million.
That was true for some people.
That's right, but not everyone.
Yeah.
It's false. You cannot say that to people, and I don't know how he's getting away with it. That's wrong. That's incorrect. Okay, now back to average annual rate of return. We've got some, we do some fun stuff with average annual rate of return.
Yep.
But the important part...
It's in every presentation that we do.
Yeah. The important part about average annual rate of return is that it doesn't actually mean you make any money. See, here's what happens. What has he got? An average annual rate of return at 11%? Think about it. Now, I'm not going to get these numbers exactly correct. I'm really not. But think about it for just a moment. Let's say you lose 25. Let's make it higher. Let's say you lose 50% in 1 year. 50%. And the next year, you make 90%. Right? What's your average? 11. Could be, right? Somewhere around there. Someone at home check me, but I'm not too far off. 11, 12, 13, 14. It's somewhere around there. That's your average. But if you actually put some dollars to it, let's put $100 to it. Okay. So Ryan, we got $100, all right?
Yep.
We lose 50%. How much do we have?
$50.
$50. Okay. We make 90% on $50.
90% on 50.
Is that 40, 45?
45.
45.
Yeah, 45.
So how much do we have? 50 plus 45.
We have 95.
Average was what? 11, 12,
11%,
13, 14,
somewhere
15?
around there. But we have less money than what we started with.
But you lost $5.
Yeah.
See, that's how average works.
And we lost the time.
And you lost 2 years. That's how average works. But not for Dave, apparently, because his average, you will have $214,000. I hate it. I think he's lying to us about this particular avenue on his site and what he says. This is not true. That is not how it works. That's not how math works.
And we're bad at math.
And I'm not claiming to be good at math, but that is not how math works. And that's not how investments work. That is false. That is wrong. And I do not know how he gets away with putting stuff like that on his site.
Yeah. So has some extra stuff, blah, blah, blah. We're going to skip ahead to the last part here. This is the facts, the FAQ.
All right.
So is term life better than whole life? Just starting off strong, I suppose. Here we go. We do want to see your family well protected, and we for sure want your financial future to include wealth and the chance to become self-insured. The only kind of policy that lets you hit all those goals is term life, but whole life misses the mark in every department.
Wildly false statement.
Yeah, because if you want your family to be well protected, again, we went over this. With term, you have a death benefit that rarely pays out. With whole life, you have a
scream well protected.
Yeah, with whole life, you have a death benefit that is guaranteed to pay out.
He also mentioned self-insured again, which you know how I feel about that. But here's my 2 cents about it. When my family, my mom, my grandma, cousins, when they ask me about being self-insured, I'm going to tell them to run the other way. Why would anyone want that? I just don't get it. That is awful.
Yeah.
But Dave says you're supposed to be working toward that. Working toward if you get into accidents, if you're hurt at work, if you're in a car accident, when you pass away, no money goes to your family because you were self-insured. I don't know. I don't get it.
Yeah. And then last thing here, what happens to term life insurance at the end of the term? It's nothing sensational. The policy will just expire, but you won't notice. You'll already be in the money.
What money? Oh, from the investments?
Theoretically.
The theoretical investments where you're guaranteed to get $214,000 according to Dave's website.
Yeah, an average annual return of 11%.
And he also says you won't notice when your term expires. Oh, boy.
That couple noticed.
Yeah, that's what I'm saying. The people who call me notice, right? I wonder if it was so easy to get 11% return and make $200,000, why don't more people do it then? I wonder, right? I see a lot of people who are putting their money in qualified plans in the market. Let me ask you this question, Ryan. Truth, I didn't prep you for this or anything, so I just want you to be truthful.
Okay.
Do you know anyone at all? Does your family know anyone, friends, colleagues, family members? I don't know. That's like ecstatic, elated, so happy about how their 401k or their IRA did. They're living off it. They're doing great. Anybody?
No, I haven't heard anyone.
I have never even heard of anyone like that.
What we're hearing, especially with a lot of the people who call in, is they're looking at the numbers and going, this doesn't add up.
Yep.
I can't live off of
I
this.
made it to $1 million and I retired, but hold on a second. I just lost 30% last year and now I'm not working and I took $100,000. Uh-oh.
Yeah. The number's going down.
Yeah. This is not going to work.
Yeah. Maybe for 10 years,
Yep.
but what happens if you live 11 years?
There it is. Anyways, that is our episode today. It's the misinformation from very, very popular influencers out there. And again, we're singling out Dave on this particular podcast, but there's more. There's other people. Susie Orman, I can name a bunch that talk just like this and give out information that is incorrect. It's just wrong. There was 4 or 5 things that were on his site today that were just incorrect, just wrong. But before we jump, we actually want to give a quick shout out to our fan follow of the week. All right, our fan follow this week is a gentleman by the name of Tony B. Amazing. Tony B. Amazing. He's actually coming to us from YouTube again. And so, Tony, appreciate you subscribing to our channel. I appreciate you watching and paying attention to what we're doing here at the Cash Compound. If you've got questions, thoughts, concerns, man, put them in the comments. Send us an email or something. We want to be able to answer and kind of single you out this week for this episode. We appreciate that subscription, and we look forward to chatting with you, answering your questions. All right. And that's it for this episode on Dave Ramsey and the misinformation about term and whole life, even listed on his site. You've got to come back and join us again next week for a new topic, and we'll see you guys next time.
Bye.